Hello and welcome to MasterChartsTrading.com market recap for Friday, July 2nd, 2015. As you're probably aware, markets pulled back pretty hard on Monday on the news of Greek drama, and the technical damage was most evident in the tech sectors, and we'll look at market breadth for QQQ S&P 500, but IWM, the small caps, are holding up better than the rest of the market. Also, the bonds are still at critical support, and we'll see if they actually do get pushed into the bear market. The US dollar index rallied, and this is putting pressure on gold in particular. And on the opposite side, corn and some of the soft commodities like grains are really broke out this week and are becoming market leaders, in fact. And we will look at, two different approaches to trading. One is a breakout buying, and the one is buying on pullback, and see if which one is better suited or which one you like more. All right, let's go to the chart. So this is a chart of S&P 500 large cap index with lots of different market breadth indicators on it. So it's still a bullish chart, definitely bullish chart. I mean, we're still making series of highs and higher lows, and this looks like a higher low here. However, if we go ahead and break this support here, I think we may head even lower, possibly to this support, to the 1988 area. This hasn't happened yet. Looks like we did break this first support from the June lows here and close below this June lows, but we since rallied back up. So in terms of numbers for the week, the actual S&P 500 did not lose that much for the week, only like a percentage point. But you can still see that there are divergences present. So unbalanced volume is pushing lower while the index itself has not yet made a lower low. The unbalanced volume indicator already made a lower low here. And the same for advanced decline line. Looks like we're breaking even, going even lower here as well, and we're still above the mid-March low for the index itself. So those are bearish divergences in my opinion, and they may continue. So I think we have kind of two possibilities here. As number one, the bearish divergences take precedent, and we do break the support and close below the support and then push lower. In that case, once this does happen, the bearish divergences will no longer be divergences, they will be a confirmation of the market decline. The opposite is we could potentially just hold this support and just rally back up. And then if this does happen, I'm hoping that divergences will resolve and we'll make a higher high in the advanced decline, and then definitely volume needs to pick up for the S&P 500. Now, as far as the market timing is concerned, we are already oversold in an oversold territory, as for example in MACD, and that means that buying opportunities are being looked at by bulls, and me as well. I'm still bullish on this chart. So basically at this point, a re-entry opportunity is probably a good idea at a certain point in the future. Market breadth momentum oscillator, you can see that it came up above its 10-day moving average, and this looked like a breadth thrust right there, but it failed. So we're now again pushing lower below its 10-day exponential moving average. So this is not a very good sign, and what I want to see is a push above the 10-day moving average by this breadth momentum oscillator. This has not happened yet. Now, what is promising is the fact that this is a indicator called new highs less new lows percent. So this is just basically takes a number of new highs, subtracts the number of new lows, and divides it by the total number of issues. In this case, there's 500 issues. So you can see that even with the pretty nasty selling on Monday, the number of new lows less new highs did not exceed less minus 5%. And this is, I mean, there's some selling pressure. This just shows that there's some selling pressure, but not that much of it yet. So that's definitely good news. And let me show you on the next chart of QQQ that this is a chart of QQQ with similar indicators on them, and you can see, let me show you the net new highs less new lows indicator. You can see that it did go below -5 for 2 days in a row. So this is, in my opinion, definitely not a good sign, and I want to see a net new highs less new lows go above +5 before I commit any money to QQQ. Also, there are divergences as well. So there's unbalanced volume divergence, because you can see that unbalanced volume is pushing lower while the QQQ was pushing higher. And similar things with thing with the advanced decline line. It was pushing lower while the index itself is still pushing higher, making higher lows. So, and again, very similar picture as with S&P 500. Basically, we'll see if we break down and possibly retest this 200-day moving average, and then in that case, divergences will be worked off. And alternatively, if we rally from here, and hopefully the divergences will resolve by making higher highs and higher lows, especially if the volume picks up. So we need to see higher volume for bulls to prevail. Also, I wanted to show this chart of XSD, the semiconductors ETF. Now, I know it's not a very highly traded ETF, but it's still a very good indicator of the industry group as a whole, because it's a very diversified ETF. So you can see that the selling in this tech sector started even earlier. It started on Monday, rather on last Friday, before the Greek crisis news that broke over the weekend, and Monday selling took place here. So this was kind of like an interesting tell that the high beta end of the market, the high volatility and the high volatility and high beta end of the market reacted before even the Greek news broke out. So, in other words, it's interesting. So similar thing is, and you can see also the stock chart technical rank. It used to be above 90 here, and now it dropped to 75. So it is no longer one of the leaders in the markets as well. So it is oversold, but in my opinion now, I mean, it's still a very strong ETF. 75, it's in the upper 75 percentile percent of the, or rather in the upper 25% of the market. But there are other even stronger groups out there, like for example biotech or some of the other ones. So next, I want to show IWM, the Russell 2000. This one is a stronger chart, especially considering that there's less divergences. In fact, you can see on the advanced decline line, it was pushing higher, making higher highs, higher lows. So no divergence in advanced decline line. On balanced volume, similar thing, pushing higher, making higher highs, higher lows. So this is a stronger chart, and the stock chart technical rank also is pretty strong. It was actually above 90 for several periods here. Now, you can see that the new highs, new lows indicator kind of actually pushed lower, especially on last today on Thursday. This close on Thursday was not particularly exciting. I think this support may not hold, and we may continue lower to first support around 122, which is still well above this low, and the high highs high lows pattern still continues. And also, it is not yet oversold to the point where I'll be comfortable adding or buying more position as well. And you can see that the Brett's momentum oscillator is still dropping and it's still in positive territory, but once again, it's not yet oversold, and I'm not yet comfortable adding more or buying on this dip. Let's look elsewhere in bonds, TLT, Treasury bonds. First of all, this chart is weak. You can see that there. You can see there is a bunch of uh, lower highs and lower lows, and lower highs and lower lows. And right now, last week I said that we're at critical support basically. Some say that this 50-day moving average moving below the 200-day moving average is the start of a bear market. I use some other ways to determine whether or not a security is in a bull or bear market, and I still don't think it is in a bear market. It is definitely close to it, and I think that once or if TLT breaks the support at 114.64 by closing below the support, I would say that definitely we're now in a bear market. I don't think TLT is yet in a bear market, and for now, I think the support has held. Considering that also summer months are bullish for bonds, I still think we may see a rebound in TLT, and possibly depending on how much this Greek thing or whatever else might unravel, we might see a push by investors into safety, and definitely TLT treasuries are a safety asset. No divergence in unbalanced volume. It's definitely making lower lows and lower highs. Now let's look at the US dollar. So I mentioned here a couple of weeks ago that I thought that this was the support held, and indeed it did hold, and we got a substantial rally here. So this rally in the dollar is putting even further pressure on commodities, especially gold and oil. And I'm gonna cover gold in this video, and maybe oil some other time. But oil actually did break down, and I'll show next video maybe. So here we can see that the dollar rallied, and let's look at gold now on the gold chart. But notice on this chart right here, this is a Monday's price action. You can see that Monday the dollar actually lost about 0.75%. This was quite a bearish candle. Now let's see what happened to gold on Monday. So chart of gold spot price. So this is a Monday's candlestick right there. So in other words, close on Friday was right here, and the close on Monday was right here. So this looks like a spinning top, or a possibly a hanging man, or but the important thing is it gapped up higher and closed down lower. So this meant that the prices, first of all, were not able to break out above this 20-day moving average or even above this 10-day moving average, and they got pushed back down. So in the face of a weaker dollar, the gold could not even break out above 10-day moving average, is definitely not a good sign. And you can see the next day, as dollar rallied further, and the day after and the day after, gold sellers came in and pushed the prices lower significantly. So Thursday was the last day of trading for the week, because in the United States we have a 4th of July holiday coming up. You can see that gold closed at 1165. This is below this level from May 1st. Definitely not a good sign again. Now this is a hammer candlestick, and hammer candlesticks mean that the buyers came in during the day and pushed the prices up, and they closed, well, somewhere around the open. But this is this support is still tentative, especially since we're now below this May level, a May low. Um, you can see that it's pushing lower and lower and lower. I think we still may retest lows from mid-March, and GDX, the gold miners ETF, is already doing that. So next chart, let's look at GDX. GDX, gold miners ETF. You can see that as gold was just a little bit of up and down, GDX is a more volatile security, and on Wednesday actually we did get a close at 17260 below this March low. So GDX is already testing this support from March lows, and in fact it closed below this low. But this is an ETF, and there are many moving parts, so it's difficult to say 100% certainty that there's I basically give it a little bit of a leeway, and yeah, I know it closed below this level, but it's not an exact science, I think. Also, today on Thursday, you can see that this pattern is called an inside day, whereas on Wednesday there was a big red candlestick. On Thursday, today, this entire candlesticks range was inside the Wednesday's candlestick range. So this is called an inside day, and it's kind of like a powerful pattern, sort of like a triangle consolidation. Now, this is a downtrend in securities, so a triangle consolidation should it continue, and we may see the resolution usually is in the direction where it was coming from before. So this was a bearish security, means going down, but this is a possibly a sign of a bottom, maybe at least from this side, from this point, from this level. If we close above this pattern, we may see a rally to around 20-day exponential moving average, so around 1850, just from this pattern alone. But if we close below it, I think we can easily drop more than 2%, maybe even more, because back here there are lows going back to beginning of end of last year as well. Advanced decline volume line made hit a new low for the move. Not a good sign either. Now, the only thing I can see that is somewhat positive in this chart is that I think there is a higher low in unbalanced volume put in. So maybe there is some accumulation happening here, and we may see a like bottom pick and rally sort of. But this is a MACD indicator. You can see that we're not that oversold yet. Like for example, here in mid-March, we're pretty oversold, but here we're not yet that oversold. So if we break this support, that could be pretty bearish. In fact, let me zoom out to maybe 10 months, and I want to see where that level is. Yeah, so yeah, I think that if we break the support, we could easily go to 1634 to retest this level, and of course 1697. Right. So anyway, so that's all I wanted to say about the chart. So there is a potential support, but it's this is a bearish security, so my money is literally on the downside. So next is I wanted to show a one of the commodities I don't normally trade it, but I kind of caught my attention is this is a very strong breakout. So this is a breakout above resistance, a pretty clear one. There's a clear resistance level here, and this is a big hollow candlestick, a very strong one. So in other words, prices opened here and they closed here within the day. So that's a very strong breakout, I think. Now, a strong breakout will hold while a weak one will fall. So basically at this point, I want to see, this is still a bearish security. You can see that it was trading going lower and lower and lower, and all of a sudden there's this huge rally. Very positive sign, but I still want to see a pullback, a retest of this breakout, and then a rally. And then next a couple of charts, I'll show what I mean of buying on breakout versus buying on a pullback after a breakout. So first, let's look at a breakout, and this is a energy stock, ENSCO. So here in May of 2014, June 2014, you can see a breakout above $50 right here, and it looked pretty promising. And this was about 5% move. So let's say you caught this breakout and you bought this stock right there at 5%, right here, and you were able to ride this to the top and you exited for some reason. Okay, wonderful. You pocket 5% right there. But for some reason, it's pretty difficult to see because usually people look, okay, I'm gonna buy this breakout and my stop would be, or let's say, a close below this support. So a breakout by here, it came down, tested the support, bounced again, and then broke right below it. So at this point, some people would say, oh, look, this is a bullish crossover. We have a 50-day moving average going above the 200-day moving average. But at the same time, looks like it broke down. And you can see the StochCharts technical rank actually never even made it above 60. So it was firmly in a bearish camp. And then the support was broken. So this was basically this is a failed breakout right here. And then here we see a test of support, a rebound, and a failure of a support retest and a breakdown again. So this is a bearish security, and let me show you what happened afterwards. So I'm gonna zoom to current day. You can see right there failure of support, breakdown, pull back to the 50-day moving average, another breakdown, pull back to the 50-day moving average, another break. So basically what you're saying is a series of lower lows and the lower highs. Now let's look at a different example, and this is example of Allstate from actually back 2012. I found that it was a decent example. So similar thing, this was a downtrending security here, but then all of a sudden we see a sharp rally and a breakout. And this is a clear resistance levels here at around $26. It broke out again above resistance and continued the rally. Now, some people will say, oh, if you buy right here on breakout, you could make nice, good money here. But as I showed the previous chart, you could also easily lose a lot of money. And buying breakout, I think, in my opinion, is more dangerous than buying on pullback. So it's kind of like the second mouse gets the cheese. So in my opinion, this breakout was like a first good step. Then security became bullish, but not just by this 50-day moving average going above the 200. I use other methods to determine whether or not this is a bullish or bearish security. Then here around May of 2012, you could see there was a pullback to the 200-day moving average. At the same time, you can see that StochCharts technical rank was above 90. So in other words, this was a very strong security pulled back within an uptrend. So in my opinion, this was a decent entry opportunity right here. And you can see immediately that it was already rewarding. So this was about 20% move. So let me now zoom out to today, and I show you what happened afterwards. You can see that the security continued higher on a huge run. So basically, I think it tripled. It doubled here from $32 to 72 or so. So in other words, what I'm trying to say is you could buy on breakout, but in my opinion, it's much safer to buy on pullbacks following the breakout. All right, that's it for this week's recap. Let me show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a blog there, and this information will be posted there shortly. We have a video section and the public chart and social page. The charts that you're watching in this video and in the write-up, they're usually located in this link on public charts page. Please do sign up for our mailing list, as you'll be the first to receive an offer to get on our trade alert services. And if you have Twitter, Facebook, YouTube, or StockTwits account, please follow us there as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye-bye.